Did you know that in parts of California, home prices have already dropped by over 25% in less than a year, and experts warn this could be just the beginning? What if the house people once fought bidding wars over is now sitting unsold for months with price cuts happening quietly behind the scenes? Across the state, something unusual is unfolding. Inventory is rising, demand is slowing, and thousands of homeowners are suddenly stuck. Backed by recent housing reports and migration data, analysts are now seeing patterns that look very similar to early warning signs from past market downturns. But this time, it's happening faster and in places no one expected. In today's video, which we're counting down the 10 California cities where home prices are crashing right now in 2026, starting from number 10 all the way to the most shocking city at number 1. Stay with me because what's happening at the top of this list could completely change how you see the housing market. Number 10, Sacramento. Just a short time ago, Sacramento was one of the hottest housing markets in California. Buyers from expensive coastal cities rushed in, driving prices up at an incredible pace. Homes were selling in days, sometimes even hours, with multiple offers and bidding wars becoming the norm. But now, that momentum is starting to fade, and fast. So, what changed? The biggest shift is the return of in-office work. During the pandemic, remote jobs allowed people to move farther away from cities like San Francisco. Sacramento became a top choice because it offered lower prices and more space. But now, as companies tighten policies and require employees to come back, many of those buyers are either leaving or simply not buying anymore. At the same time, interest rates have climbed, making mortgages significantly more expensive. According to housing data trends, even a small increase in rates can reduce buyer demand dramatically. In Sacramento, this has led to a noticeable rise in unsold homes sitting on the market longer than expected. Sellers who once had full control are now being forced to cut prices or offer incentives just to attract attention. Another factor is the growing supply. New listings are increasing, but fewer buyers are stepping in. This imbalance creates downward pressure on prices. Some analysts even point to early signs of overcorrection, where prices rise too quickly and then fall just as sharply. For viewers, this raises an important question. Is Sacramento becoming a buyer's market again? If you're thinking about purchasing, this could be an opportunity to negotiate better deals than we've seen in years. But if you're a seller, our timing has suddenly become everything. And here's the thing. If this is happening in a city like Sacramento, which was once considered safe, then what's happening in the next city on our list might surprise you even more. Number 9, Fresno. For years, Fresno was seen as one of California's last affordable housing options. Families priced out of coastal cities moved here hoping to finally own a home without overwhelming financial pressure. Prices rose steadily and demand stayed strong. But now, in 2026, that story is beginning to shift, and not in a good way. The biggest issue hitting Fresno right now is affordability pressure combined with rising interest rates. Even though homes here are cheaper compared to cities like Los Angeles or San Francisco, higher mortgage rates have made monthly payments much more expensive. Studies in housing economics show that when borrowing costs rise, middle-income buyers are the first to step back, and that's exactly what we're seeing in Fresno. As demand slows, sellers are finding themselves in an unfamiliar situation. Homes that once sold quickly are now sitting on the market for weeks, sometimes months. This has triggered a wave of price reductions, with many homeowners lowering their expectations just to stay competitive. At the same time, there are early signs of foreclosure activity increasing, especially among buyers who purchased at peak prices with tight budgets. Another factor is local economic sensitivity. Fresno's market relies heavily on stable employment and steady income growth, and any disruption, whether from inflation or job uncertainty, can quickly impact housing demand. This creates a ripple effect where fewer buyers enter the market, pushing prices downward. So what does this mean for you? If you're a buyer, this could be a moment to wait and watch carefully because prices may continue to soften. But if you're a homeowner, the window to sell at peak value may already be closing. And if Fresno is starting to feel the pressure, the next city on our list is facing an even more intense shift. Number 8, Bakersfield. Not long ago, Bakersfield was attracting a wave of investors and first-time buyers looking for cheap entry points into California real estate. Compared to the rest of the state, prices were relatively low, rental demand looked strong, and many believed this market had plenty of room to grow. But in 2026, the situation is starting to turn in the opposite direction. One of the biggest reasons behind this shift is the slowdown in investor activity. During the housing boom, many investors purchased properties in Bakersfield expecting steady rental income and long term appreciation. But now, with higher interest rates and rising maintenance costs, those same investors are beginning to pull back or even sell off properties. When multiple investors exit at once, it creates sudden pressure on prices. At the same time, Waikiku's Bakersfield's economy is still heavily tied to the oil and energy sector. Research shows that markets dependent on a single industry are more vulnerable during economic shifts. As energy markets fluctuate and job stability becomes uncertain, fewer people are willing to take on large financial commitments like buying a home. This leads to lower demand and increasing supply, a combination that often pushes prices downward. Another issue is the softening rental market. As affordability tightens nationwide, some renters are doubling up or moving to cheaper areas, reducing demand for rental units. This directly impacts investors who may struggle to fill properties, forcing them to lower rents or sell at reduced prices. So, what does this mean moving forward? If you're an investor, this is a time to be extremely cautious and focus on long term stability over quick profits. And if you're a buyer, opportunities may appear, but timing will be everything. And if you think this situation sounds serious, the next city on our list has seen this kind of volatility before, and it's starting to show again. Number 7, Stockton. If there's one city in California that knows what a housing crash feels like, it's Stockton. This city was one of the hardest hit during the 2008 financial crisis, and now in 2026, some experts are quietly warning that history may be starting to repeat itself. Back then, Stockton became a symbol of what happens when home prices rise too fast without strong economic support. And today, we're seeing similar patterns forming again. During the recent housing boom, prices surged as buyers searched for more affordable alternatives outside major cities. But now, with interest rates rising and affordability shrinking, that demand is fading quickly. One major concern is household debt levels. Studies show that when people stretch their budgets to buy homes at peak prices, even small economic changes like higher monthly payments or job instability can create serious financial pressure. In Stockton, this is starting to show through longer listing times and increasing price cuts. Unemployment trends also play a role. Compared to wealthier regions, Stockton's job market can be more sensitive to economic shifts. When uncertainty rises, fewer buyers enter the market and existing homeowners may be forced to sell. This creates a cycle where more supply enters the market while demand weakens, pushing prices down further. What makes Stockton especially important to watch is its history of volatility. Markets that have crashed hard before often react faster when conditions change. It's like an early warning signal for broader trends across similar cities. So if you're a buyer, this could become an opportunity, but only if you move carefully. And if you're a homeowner, understanding market timing is now more critical than ever. And if Stockton is already showing signs of stress, the next city on our list is facing a completely different but equally powerful shift. Number 6, Riverside. During the pandemic boom, Riverside became one of the most desirable housing markets in California. Families rushed here for bigger homes, lower prices, and more space, escaping the high cost of coastal cities. Demand exploded almost overnight, and prices followed just as fast. But now, in 2026, that same market is starting to cool down, and the shift is becoming impossible to ignore. The biggest factor behind this change is the return to city life. As more companies push employees back into offices, long commutes from Riverside to places like Los Angeles are becoming less attractive. What once felt like a smart move is now turning into a daily burden for many homeowners. As a result, fewer new buyers are entering the market, and some existing residents are even considering moving again. At the same time, higher interest rates are making it harder for buyers to afford homes. Research shows that when mortgage costs rise, demand drops quickly, especially in areas that saw rapid price increases. Riverside fits this pattern perfectly. Homes that once received multiple offers are now sitting longer, and sellers are being forced to adjust expectations and lower prices. Another clear sign of a shifting market is the increase in days on market. This metric has been rising steadily, indicating that homes are no longer selling as quickly as before. In some cases, sellers are offering incentives like covering closing costs just to attract buyers. So, what does this mean for you? If you're looking to buy, Riverside may soon offer better deals and more negotiating power. But if you're selling, The urgency to act before further price drops could be critical. And if Riverside's slowdown feels surprising, the next city on our list is dealing with even deeper financial pressure behind the scenes. Number 5. San Bernardino. Right next to Riverside, San Bernardino is facing a housing shift that's even more intense and for many residents, far more personal. This has always been a market where affordability plays a major role, attracting buyers who are already stretching their budgets. But in 2026, that pressure is starting to crack the system from within. The biggest issue here is the growing gap between income and housing costs. Even though home prices are lower compared to other parts of California, wages haven't kept up with rising expenses. Research consistently shows that when housing costs take up too much of a household's income, the risk of financial stress and forced selling increases. And that's exactly what's beginning to happen in San Bernardino. Add to that the impact of inflation and job instability, and you get a market where many homeowners are struggling to keep up with mortgage payments. Early signs of distressed sales and foreclosures are starting to appear, especially among buyers who purchased during peak pricing with minimal financial cushion. Another factor is the rise in inventory levels. As more homeowners list their properties either by choice or necessity, the supply begins to outweigh demand. This creates a situation where buyers have more options and sellers are forced to compete by lowering prices. It's a classic setup for a price correction, and San Bernardino is right in the middle of it. For viewers, this raises an important point. Markets driven by affordability can shift quickly when economic pressure builds. If you're a buyer, patience could reward you with better deals. But if you're a homeowner, staying financially prepared is more important than ever. And if you think this level of pressure is serious, the next city on our list is seeing changes driven by something completely different, yet just as powerful. Number 4, Oakland. At one point, Oakland was seen as the next big thing in the Bay Area. With its proximity to San Francisco and relatively lower prices, it attracted a wave of young professionals, especially from the tech industry. Neighborhoods transformed, demand surged, and home prices climbed rapidly. But in 2026, that momentum is starting to reverse and the shift is being felt across the entire city. One of the biggest drivers behind Oakland's slowdown is outmigration. Over the past few years, a growing number of residents have been leaving the Bay Area in search of lower costs and better quality of life. Studies on migration patterns show that when people move out faster than new buyers move in, housing demand drops and prices follow. Another major factor is the change in the tech workforce. With remote and hybrid work becoming more common, many tech professionals are no longer tied to expensive urban areas. Some are relocating to entirely different states, while others are simply choosing not to buy in high-cost cities like Oakland. This shift has reduced buyer competition significantly. There are also growing concerns around urban living challenges, including safety perceptions and overall cost of living. While these factors vary by neighborhood, they still influence buyer decisions. When confidence in a market weakens, even slightly, it can lead to longer selling times and increased price cuts. As a result, Oakland is now seeing more listings stay active for longer periods, and sellers are beginning to adjust prices to attract fewer buyers. The days of instant sales and aggressive bidding wars are fading. For now. For viewers, this creates a key question. Is this a temporary slowdown or the start of a deeper correction in urban markets? Because if Oakland is already shifting, the next city on our list is facing pressure from one of the most powerful forces in the entire economy. Number 3, San Jose. When you think of wealth, innovation, and skyrocketing home prices, San Jose usually sits right at the top. As the heart of Silicon Valley, this city has long been powered by the tech industry, with high-paying jobs fueling one of the most expensive housing markets in the country. But in 2026, even this powerhouse is starting to feel the pressure, and it's coming from within. The biggest factor behind San Jose's slowdown is the wave of tech layoffs and hiring freezes. Over the past year, several major companies have cut costs, reduced staff, or slowed expansion. Research shows that when high-income earners face uncertainty, they delay big financial decisions like buying property. In a market like San Jose, where home prices are already extremely high, even a small drop in demand can lead to noticeable price corrections. Another issue is the shrinking pool of buyers who can actually afford these homes. With interest rates still elevated, monthly mortgage payments have surged to levels that many buyers simply can't justify. This has created a situation where luxury homes, once the most competitive segment, are now seeing price reductions and longer selling times. There's also a subtle but important shift happening. Some tech workers are no longer tied to Silicon Valley. Remote work options allow them to live in cheaper states while keeping their jobs. reducing the urgency to buy in San Jose. This shift is quietly weakening demand over time. So, what does this mean? If you're a buyer, bueno, this could be one of the rare moments where negotiating power starts to shift in your favor, even in Silicon Valley. But if you're a seller, pricing your home correctly is now more critical than ever. And if a city like San Jose is starting to slow down, what's happening in the next one might be even more surprising. Number 2, Los Angeles. When it comes to real estate in California, Los Angeles has always been one of the most powerful and resilient markets. From luxury mansions in the hills to compact apartments in the city, demand has historically remained strong, even during uncertain times. But in 2026, something unusual is happening. This massive market is starting to slow down, and the signs are becoming harder to ignore. The biggest pressure point right now is affordability. Los Angeles has always been expensive, but with higher interest rates, rising taxes, and increased living costs, the average buyer is being pushed out of the market. Research shows that when monthly mortgage payments cross a certain threshold, demand drops sharply, and that's exactly what's unfolding here. Another major factor is the shift in buyer behavior. People are no longer rushing into bidding wars like before. Instead, they're becoming more cautious, waiting for better deals or choosing to rent instead of buy. This change in mindset is leading to longer listing times and more frequent price reductions across multiple neighborhoods. At the same time, there's been a noticeable increase in inventory levels. More homes are being listed, but fewer buyers are stepping in to absorb that supply. This imbalance creates downward pressure on prices, especially in mid-range and even some high-end properties. There's also the impact of migration trends. Some residents are moving to more affordable states, reducing local demand further. When a market as large as Los Angeles begins to shift, it often signals broader changes happening across the region. So, what does this mean for you? Buyers may finally gain some negotiating power in a market that once felt impossible to enter. But for sellers, pricing strategy and timing are now more important than ever. And if Los Angeles is already feeling this pressure, the number 1 city on our list is experiencing something even more dramatic. Number 1, San Francisco. And now, the most shocking city on this list, a place once considered untouchable when it came to real estate, San Francisco. For years, this city symbolized extreme demand, sky-high prices, and fierce competition. But in 2026, the narrative is changing, and the shift is far more dramatic than many expected. The biggest force behind this decline is the long-term impact of remote work. Unlike before, thousands of high-income professionals are no longer required to live close to their offices. Studies on post-pandemic work trends show that when location flexibility increases, demand for expensive urban housing can drop significantly. And in San Francisco, that effect has been massive. Another critical factor is the wave of tech layoffs and cost-cutting measures. As major companies restructure, fewer people are willing or able to buy homes at premium prices. This has weakened demand at the top end of the market, leading to noticeable price reductions, especially in luxury condos and high-end properties. One of the clear signs of this shift is the rise in vacant units and unsold listings. In some areas, homes are staying on the market far longer than they used to. Sellers who once had full control are now quietly lowering prices, sometimes multiple times, just to attract serious buyers. There's also the broader issue of population decline. Migration data indicates that more people have been leaving San Francisco than moving in, further reducing housing demand. When fewer buyers compete for more properties, prices naturally begin to fall. But here's the twist. While this may sound alarming, it could also signal new opportunities. Buyers who were once completely priced out may finally find a way into this market. The real question is this the bottom or just the beginning of a deeper correction? So, what does all of this really mean? Across California, from Sacramento to San Francisco, we're not just seeing random price drops. We're witnessing a larger market shift driven by powerful forces like rising interest rates, changing work patterns, migration trends, and economic pressure. And when all of these factors come together at once, even the strongest housing markets can begin to crack under pressure. But here's something important to understand. This doesn't automatically mean a full collapse is guaranteed. Real estate markets move in cycles. What we're seeing right now could be a correction after years of rapid growth where prices simply rose too fast and are now adjusting back to more realistic levels. In fact, many economists and housing studies suggest that these corrections are a normal part of long-term market health. Well, for buyers, this could be the moment you've been waiting for. Less competition, more inventory, and increasing price flexibility mean you may finally have negotiating power in markets that once felt impossible to enter. But timing is everything. Jumping in too early or too late can make a big difference. For homeowners and investors, the message is clear: stay informed and stay prepared. Markets can change quickly, and understanding trends early can help you make smarter decisions before conditions shift further. Now, I want to hear from you. Which city shocked you the most? Do you think this is just a temporary slowdown or the beginning of something bigger? And if you found this breakdown helpful, don't forget to like the video, subscribe to the channel, and check out our next deep dive on where the market could be heading next.